Now, let's move on from the good and the bad to the ugly. And I'm not going to do the ugly with regards to the macro. I'm going to do the ugly with regards just to the resource stocks, and in fact, just the small resource stocks. Two things that I want you to think about in the context of ugly. One is the incredible explosion in the sector of general and administrative expenditures. It turns out that most of these little resource companies are mini governments. You know, in the resource industry, in the exploration stage at least, that they don't make any money. They just lose money. What is scary to me is the amount of money that they are spending on general and administrative expenditures relative to exploration expenditures. I'm not saying all the resource companies, but what I am saying is that the sector is becoming increasingly lifestyle-oriented and less exploration-oriented, as is represented by the fact that the general and administrative expenditures in these companies are beginning to greatly outpace the exploration expenditures. In other words, you are funding much more general administrative expenditure than you are funding exploration. The second problem in terms of ugly with the resource business is what I call private inflation. You come to a conference like this and a lot of people will tell you, God, the central bank is doing this, they're doing that, they're printing all this counterfeit currency. I want to tell you that the private sector can do anything better than the public sector can, including inflation. And when you look at the fact that in the last 3 years or something like that, the price of junior mining shares hasn't gone up, it hides the fact that the market capitalization of the sector has gone up. How has that happened? Because they've issued more and more and more shares. And the truly ugly part of the junior exploration sector is that if you merged every junior exploration company in the world into one company, Junior Explorco, in a very efficient year, the industry as a whole would lose $2 billion. That is, it'd spend $2 billion more than it generated in takeovers, earnings, stuff like that. In a bad year, it'd lose about $8 billion. So how would you value the whole sector? What would be the correct price-loss ratio? Would you value the industry at 5 times losses? Seems modest to me. How about 7 times losses? In a bull market where gold is in favor, perhaps you could value it at 12 times losses. You get my point. The truly ugly fact is that the sector as a whole continually and will always lose money. If you are a junior resource investor and you are invested in the sector, it's only a matter of time. It is inevitable. It may not be imminent, but you will lose money. So why do we do it? Because there is so much money to be made identifying the best players in the sector. The performance of the best players in the sector add excitement, they add hope, they add liquidity that keeps the whole rest of the sector alive. And what people like you in this room, people who have spent the money, who are willing to work, who are willing to invest the time, have the ability to do. Doug Casey talked about performance dispersal curves and Pareto's law. If you concentrate your efforts on the best 4% of the players, you're going to get it wrong occasionally. You can spare yourself the ugly in the good, the bad, and the ugly. It's amazing, but the activities of probably 5 management teams in Vancouver have generated almost all of the positive performance that has been generated out of that market in the last 30 years. And the way that you avoid the ugly in the context of the good, the bad, and the ugly is simply to concentrate your efforts and use common sense. And remember these 2 phrases, inevitable and imminent. I'm going to begin, I think, in the next little while to tell you how to do that this year. And I'm going to do it in the context of the fact, and this is hard for a lot of people to understand, bad markets are good, and good markets are bad. Do you remember how aggressive you all felt in 2010? I remember I'd come to the Casey conferences and people were buttonholing me and sort of pushing me against the wall to get stock tips. Good markets are lethal. Your expectation of the future is set by your experience in the immediate past. And if your experience in the immediate past has been that you even made money from your mistakes, it's normal, natural human behavior to confuse a bull market with brains. You want to believe that some of those responses you generated. You have this positive reinforcement. And in bad markets, the exact opposite happens. You don't want to go out and participate in a new financing. You say, I'm losing so much money in my 8 existing positions. Why should I add a ninth loss opportunity? Thinking about this should lead you intuitively to understand that all of the people that you're competing with feel the same. Markets, in fact, work, and very, very, very good markets set up very, very bad markets. Very high prices correct themselves to low prices, and low prices correct themselves to high prices. So, where are we now? Obviously, we've had a pretty good correction. And I suspect in our sector, the correction continues. And maybe this summer it even accelerates. Why is that? This industry, the junior industry, has been increasingly institutionally financed for the last 10 years. It's been financed both in terms of the equity issuances and the aftermarkets by sector mutual funds and by small hedge funds. That's where the money's come from. And these two sectors in the market, the private funds, the hedge funds, and the open-ended, in particular, sector of mutual funds, are hemorrhaging money. They're suffering something called disintermediation. Disintermediation is simply money going home. One fairly large fund manager, who I know fairly well, was experiencing last week outflows of $10 million a day. If $10 million a day is going out of your fund, you obviously aren't buying stocks. And the stocks that you're selling are the stocks that are the most liquid. In other words, perversely, the stuff you'd like to keep, you have to sell. And the stuff you get left with is the dross. This is not the stuff that a bull market is made of in the near term. So we have a situation where just as good markets fed on themselves in 2009 and 2010, a bad market is feeding on itself today.